these timely updates to the Code of Ethics. Before I begin, maybe I just give a bit of background of why we have these updates. So maybe you have heard about all these recently, or maybe very recent years, that we have all these like Pandora papers, and then you got the Paradise paper, whereby really that the public really have like a public outcry, whereby professions that the accountants are actually involved in all these scheme whereby tax minimization and involved in all these tax avoidance matters, whereby although the legality of the matters is intact, meaning that it is legal. However, questions have been raised regarding the ethical elements of accountants involved in this type of schemes, whereby it can be termed as aggressive tax planning. And because of that, something must be done to address all these issues. So that's a very brief background why all these matters come about, and that's why we are here to have these updates. Okay, with that brief background, let's go to the subject matter proper. So we have these new ethics standards on tax planning. Okay, tax planning, very simply, what are these tax planning services? So here it says that tax planning services are basically advisory services designed to assist a client, whether it is an individual or an entity, in planning or structuring the client's affair in a tax-efficient manner. So you may have heard in the past whereby that, I mean, even in some case law whereby it says that everybody is entitled to arrange its tax affairs. So if a person or taxpayer whereby you can choose a more tax efficient manner, that he is entitled to do so. However, that thinking has now been shifted, whereby there are a lot of tax planning going around, whether domestically or even in overseas, whereby mostly all these things are really being somehow, I don't know how they got the information, maybe because we have all these like newspaper, they say like, oh, this structure whereby you have a hamburger structure and all those, whereby really you don't have to pay tax, but that is an issue on the ethical matter. So some examples of tax planning services would be like advising a client on structuring the client's affair to achieve investment or estate planning goals. And the other one will be advising on the structuring of transfer pricing arrangement, taking into account tax-related transfer pricing guidelines. So these are just some of the examples of tax planning. These are not only confined to these two. It is there are more to it. Okay, next one. We will have also these related services. So what are related tax-related services to this tax planning? So related services are basically services based on or linked to a tax planning arrangement developed by the client or even a third-party provider. This one, of course, you will still be subject to the standard that it still applies. Some of the examples involved will be like assisting a client in resolving a dispute with the tax authorities on the tax planning arrangement. And the next one will be advising the client on an acquisition whereby the valuation depends on the tax planning arrangement established by the target. Okay, now I just maybe we just share with you the very brief examples and all those. Later I will share with you some maybe case studies in more detail. Then we will see how this concept actually works in practice. Okay, next, the aim of these tax planning standards, there are many. First of all, they want to align tax planning with the public interest. So it's not just thinking about tax planning, but we also need to take into account the public interest. So whether is it aligned, is it how does it affect the public and all those. Next one will be charting a safe ethical passage through complex or uncertain situations. Next one will be putting ethics of the heart of tax planning advice. So you can see that the standard actually moves the tax planning itself to public interest ethical passage. Then you also have to think about the ethics behind the tax planning. And the next one, the fourth one, encourage responsible practices. And last one, of course, fostering trust in the tax systems. Okay, next one. Okay, what will be changing in this code of ethics? Just introducing to you two new sections whereby apply to different groups. The first one is actually section 280. This is applicable to, okay, this is a short form that we use, PAIB. But what it stands for is actually professional accountants in business. So PAIB is professional accountants in business. This will apply to all entities. The next one will be section 380, whereby this is applicable to PAPP. So this is a short form, but what it means is that professional accountants in public practice. So if you see PAIB, you know that PA is a professional accountant, IB is in business. The next one, PAPP is public practice, professional accountants in public practice. So it will involve the second one, the section 380, involve all clients, whether they are individuals or entities. So that is just to give you new sections on these two items. So it will actually cover both areas, whether you are in public practice or you are in business whereby you serve an organization internally, it will apply to you, this ethical framework. Some key elements for this ISPA, whereby what does it cover? So very briefly is that it covers the scope and applicability. So what is entailed here is addressing a wide range of tax planning activities and services. The second one will be a common description of tax planning. So what is it? So here it talks about the nature of the tax planning services or activities. And there will be some illustrations being provided. Okay, next one will be professional accountants' role in the public interest. So here what it covers is that it describes how professional accountants act in the public interest. So whatever the professional accountants are doing need to be aligned with the public interest. Next one will be responsibilities of professional accountants and clients or even the employing organization. This one will be involved the PAIB, professional accountants in business. So here what it covers is that it is outlining the respective responsibilities of professional accountants and client or even the management. Okay, next one will be, this is quite crucial, whereby it says credible basis. What is credible basis? Here it says that it requires professional accountants to determine that there's a credible basis for the tax planning arrangement. So meaning what it says that, of course, there are a lot more details, but what I want to highlight is that credible basis is that whatever tax services or even the tax planning ideas must have something as a basis. It cannot be so what it means is that you must follow the law, must follow the legislation. So some may need to do a bit of research on the practices. So whether is it in line with the tax authority, or is it being too aggressive and all those. So whatever advice being given must have a basis, and it must be credible, supported by either by law, regulations, or in line with the tax authorities' practices. So these are the some items. Okay, moving on. Okay. Also, these key elements also cover overall assessment of the tax planning arrangement. Here it requires a stand-back consideration aligned to the public interest. So before the professional accountants get involved, it may even require a stand-back consideration, standing back and look at it. How does it affect the public interest? So if I can share, like, let's say, how does it impact? If let's say some of these schemes actually being published in the newspaper, the headlights, the headlines. So how would the public actually react when they see this? So do they see is oh, this is something have ethical issue or not? So that is very high level of what it means. Next one will be navigating the gray zone. So what does it mean? It's describing the gray zone as circumstances of uncertainty as to whether a proposed tax planning arrangement will be in compliance with the relevant laws and regulations. So there are areas whereby, of course, we can break it into three. The first one is very clear cut. We know what is it. On the other extreme is that it's totally illegal. So in between, we have this gray zone. So is it legal or is it totally acceptable? So in this gray zone, so what these standards actually say is that we have to find a basis. So how do we do it? So it's actually very aligned with the credible basis also. We have to do research. Is it proper? Do we have a legal basis? Or will the tax authority challenge? How does it? So if we find out that actually in this gray zone is moving more towards the tax avoidance and all those illegals, and it could be bound to be challenged by a tax authority, then we may not want to move into that area, but moving back to the more credible basis. Next one will be applying the conceptual framework. Here it provides guidance on identifying, evaluating, and even addressing threats to compliance, to the compliance. Okay, next area whereby this is a very common one, dealing with disagreements. It provides a guideline to professional accountants in dealing with disagreement with the clients or responsible individuals within the employing organization regarding the tax planning arrangement. So involving in all these tax plannings and all those. We are not just sometimes disagree with the tax authorities. Sometimes the clients themselves, here it says that clients themselves or even the organization, for those professional accountants in business, they could even disagree with these two parties is within the organization and also the clients. So here it says that how do we deal with this type of situation? It is bound to happen because clients sometimes they may not be they are running commercial practices and all those, so commercial enrichment, they think that it is okay, but from ethical point of view for tax planning, maybe it is a bit too aggressive. So because of that, the clients or even the organization, they disagree with the professional accountants. So here it helps provide some guidelines on how do we deal with this type of situation. Next one is also very important, communication and documentation, because if all these areas being scrutinized, then most likely authorities or they will look at what what communications have transpired and what about the documentations. So here it highlights the need for clear and transparent communication with clients or management and encourage documentation. So there will be a trace of what the professional accountants have been communicating with the clients or even for those within the organizations. So if the professional accountants have been advising properly, like there must be a credible basis and shouldn't involve in all these too aggressive tax planning, then the professional accountants have done their duties. So this is actually a very wide framework, ethical framework. Okay, moving on. Okay, this just for these two sections, section 280 and then 380, the effective date. So if you look at it, it's beginning 1st July 2025, which is not very far away. Now it's already in April. So actually this webinar is actually quite timely, so that a few more months for preparations and so that there a bit of time. Of course, there is also in any provisions, there will always be these transitional rules whereby here it says that tax planning activities or tax planning services commenced before the effective date may be continued and be completed under the extent provision of the ISPA code. So whatever that is, whatever is tax planning activities, you already started before this commencement date. So under this, it says it can be completed, but of course within the provisions of the ISPA code. So it's not that everything must stop for those plannings or even services that have been started. Okay, what's the difference between these two? So as you can see that section 280, it covers planning activities. So this is, as I mentioned earlier, this is for the PAIB, Professional Accountants in Business. 380 is for tax planning services. So this is for PAPP, Professional Accountants in Public Practice. So those are the differences for these two sections. Okay, moving on. Okay, now we move on to areas. This one a bit slightly more detailed already. So just now we cover a very big overall picture and all those. Now we are coming to more details. So you can see that what are those tax services whereby whether can do, cannot do, what are the issues, and how do we address them? We also break it down into PIE or non-PIE. So PIE is public interest entities. So maybe listed entities and all those. Non-PIE, I think you all know, is non-listed entities. So those are the terms that we use. Hopefully you are not, when we look at the short form and all those, so you should, but I will explain further on that one. Cool, let's look at this one. Okay, independence for audit and review engagement. So what we have here is self-review or advocacy track. So I just list it down here. So we have tax services. So what about preparing tax returns for tax compliance and for tax agents? Then we also have another one, tax calculation for preparing the accounting entries. Next one, we have tax advisory and tax planning services. The next one involving some valuations. So tax services, but involving valuation. Last one we have is, this is regarding tax disputes. So some tax agents also involved in tax disputes, especially those involved in audit and maybe audit investigation or maybe a bit of transfer pricing. So whereby they actually dispute with the tax authorities. But we will look at it in more details, what are the areas being covered. But here, as a big picture, what it says is that this is really a simplified table summarizing the main principle. Assessment, it will be done in the next subsequent slides to look at it on a case-to-case basis. What he says is that generally for preparation of tax returns is not seen to create a threat. So PIE I mentioned is that for listed entities and non-PIE is for non-listed. And what we are saying in this context is that these clients are actually audit clients, and now we are providing the tax services. So we have this audit and checks at the same time. So generally tax compliance work, no issue. But for the rest, like preparing accounting entries, tax planning services, those we have to look at the safeguards and see what are those. Okay, we will go into more detail now. Okay, this one is the first one. Tax return preparation. This under 604.5. So what are the services being covered? So we have number one is assisting clients with their tax reporting obligations required to be submitted to the tax authorities. So this is just doing the compliance work and all those. And also, what about advising on the tax return treatment of past transaction? So the thing already happened. So now we are doing the maybe tax compliance, look at the tax return, and we look at the let's say some expenses and all those. Then we see, is it taxable or non-taxable? So those are really the tax treatments of something already happened. Third one is during an tax authorities asking for additional information and analysis, could be for tax audit and all those, or just asking for clarification. So this is really responding on behalf of the audit client to the tax authorities. This one generally do not create a threat. So these are all okay. Okay, next one. Okay, tax planning advisory and tax planning services. So here, what we have is that comprising a broad range of services, such as advising client how to structure his affair in an efficient manner, advising the application of new tax law or even regulation. Here, what it says is that it shall not provide tax service when the effectiveness of the tax advice depends on a particular accounting treatment or presentation in the financial statement. And the tax audit team actually has doubts to the appropriateness of the related accounting treatment or presentation under the relevant financial reporting framework. So what we have is that this is an audit client, and the audit team actually, they are also they have doubts to the accounting treatment of certain items. And on top of that, the tax advice is being rendered on the accounting treatment. So this is like really the auditor, they are not sure, and tax is relying on this. So that is shall not provide the tax service because you're relying on the audit, and audit is not sure. So cannot. Okay, next one is what about this one? Okay, tax advisory and tax planning services. For PIE, the safeguard is that if you have this advocacy threat, so using professionals who are not audit team member to perform the service. And if, however, this approach it adheres to the tax law guidelines and established practices acceptable by the authorities, that is still possible. But do look at the red color box here, self-review track. So firms shall not provide such services if it might create a self-review threat. So it's a no. If you fall under that one, then whatever safeguards also, it won't help. Okay, let's look at the non-PIE. Using professionals who are not audit team members to perform the service. having an appropriate reviewer who was not involved in the providing services review the audit work. So this is also quite similar to the previous one. Then you must, of course, follow the tax law guidelines and establish practices by the authorities. Okay, moving on. What about valuation? So valuation, tax services involving valuation. So we have merger acquisitions, group restructurings, corporate reorganization, transfer pricing studies, stock-based compensation arrangement. So this is also quite similar to the previous one. And do look at the box, the red color one. It say self-review track. Firm shall not provide such services if we might create a self-review track. So for PIE is quite similar to the previous one. So what is the difference between PIE and non-PIE? For the non-PIE, we have this having this safeguards is only available for non-PIE. Having an appropriate reviewer who was not involved in providing the tax service, review the audit work or service performed, but it's not available for PIE. So if even you have a different people reviewing, it won't help the situation. So that's the difference. So PIE is actually very strict. You cannot means you cannot. Even you have different people, also you cannot perform these type of services. Okay, next one, assistant in resolution of tax dispute. So what happens in this? So there might arise where an authority's consideration for tax calculation and treatment. So the authority is actually disputing. For example, providing assistance when the tax authorities have notified the client that the argument on a particular issue has been rejected, and either the tax authority or clients refer the matters for determination in a formal proceeding before a tribunal or court. So here is also quite similar. I need to pay attention also on the self-review track. And for non-PIE, the safeguard whereby you have a different appropriate reviewer not involving in the audit service, you can still provide, but for PIE, definitely cannot. Okay, next one. Okay, what constitute this as an advocate before a tribunal or court? So here it says that in the red color one, a tribunal or court depends on how tax proceedings are heard in a particular jurisdiction. So courts, of course, we know what are the courts, like just an example, High Court, Court of Appeal, Federal Court. Then tribunal, I think roughly we know also. So we have two areas, broadly one. So we have a special SCIT, Special Commissioner of Income Tax, and then the custom side also we have the custom tribunal and all those. So those are the areas where the taxpayers will actually dispute with the tax authorities. So here what it means is that a firm or network shall, this for PIE, shall not provide tax services that involve assisting in the resolution of tax dispute to a client that is a public PIE if services involve acting as an advocate. So it's like you are acting like a counselor like that. For tribunal and all those, you may not need to be a qualified lawyer to present the case. A tax agent is also possible, but for courts, definitely you need a lawyer. So if you're a lawyer and you are accountant, definitely you cannot represent the case. Okay, for non-PIE, a firm or network firm shall not provide tax services involving the assisting in the resolution of tax dispute to an audit client if it's not a PIE, if involved as an advocate. So as long as you are involved as an advocate, then it's not possible. Okay, maybe we look at some case studies because a lot of theory, and then we look at it like not sure how it works, so only talk only. What about in real life? How does it work? Okay, just give you a very it's a real life case. So we have case study number 1, MIA bylaw. Here it says that company A is planning to undertake an IPO exercise and has engaged an accounting firm to provide the following tax advisory services. So first one, A, tax advice on tax implication of the proposed corporate restructuring exercise that will be undertaken by a new company, which will be incorporated. And company A prior to the IPO exercise. Then, of course, there's a whole list of high-level tax due diligence review on the company. This one usually requested by the investment bankers because investment bankers have they actually need to ensure that for companies going for IPO, they make sure that no sudden surprise that suddenly the entities that they want to list suddenly get a high tax assessment and all those. So that could actually derail the IPO exercise because you've got a pending liability and all those. So what are the areas being covered? First of all, the major one, of course, corporate income tax. So all the corporate tax assessment and all those. Next one, withholding tax, real property gain tax, goods and services tax. So this one could be in the past, but there are some clients, they also want to look at it, make sure that covers all areas. Sales and service tax. And the last one will be on this employees money tax deduction rules, whereby all the PCB, the potongan cukai bulanan and all those, make sure it's compliant, because if the client's taxpayer miss out some of these, penalty could happen. Last one, of course, very important, transfer pricing review and preparation of transfer pricing documentation. So whether we see whether all this possible or not. Okay, here we summarize it into in a table. Let's look at the PIE client. Okay, firm shall not provide tax advisory services to an audit client if the self-review threat exists. Okay, however, advisory services will not create a self-review threat if such services are A, supported by tax authorities or precedent. So the authority is okay about that. Or even there are some precedents that we can follow. Maybe it could be a guideline, a case law, or even some practice notes and all those. So that is will not create a self-review threat. B, established practices commonly used has not been challenged by the tax authorities. And the last one, C, is have a basis in tax law that the firm is confident is likely to prevail. So you follow the law, and the law is quite clear saying that this, let's say, certain deductions or expenses can be claimed and you have a basis, then that is okay. Okay, what are the safeguards? Using professionals who are not the audit team to perform the service, and then approach adheres to the tax law guidelines and established practices acceptable by the authorities. What about for non-PIE? Generally, it's okay also. The safeguards, I think, is quite similar, except that you have another element, which is always present for non-PIE clients, have an appropriate reviewer who was not involved in providing the services, review the audit work or the services performed. Okay, let's look at case study number 2. This is in relation to assistance in the resolution of tax dispute. Company B has been subject to tax audit and investigation. This is quite common, audit investigation carried out by the, now they call it HASIL, has been issued notice of additional assessment, commonly also known as Form JA, for certain year assessment. So company B approached an accounting firm to assist them on the appeal against the assessment, which will also include services like preparation and submission of the notice of appeal. Usually we call it Form Q, together with the write-ups of the technical issues in defending the tax position adopted by the company. Then on top of that, we also need to attend dispute resolution. So maybe a very brief background. So you have dispute, so you have the IB department. There's a step whereby in between the special com, in between they still can negotiate and all those. But before going to special com, they will have this department in between. They call it dispute resolution, whereby taxpayers and the authorities, they can still sit down and see how to resolve the matter, whether the matter can be handled before passing the case to the special com. So if the matter is resolved, then you don't need to go to special com. As the case may be, to secure a final result for the company. Last one will be preparation and submission of petition of appeal should the case could not be resolved at the dispute resolution level. So you ask me, are there cases whereby can be resolved at the dispute resolution? I think they are, and in fact, we have clients whereby matters actually resolved at dispute resolution before going to the full-blown special com matters. So let's see what are the things that can or cannot. That's more important. For PIE, firm shall not provide assistance on tax dispute to an audit client if there's a self-review threat exists. Otherwise, you can accept. Quite similar to non-PIE also. Just that for safeguards for non-PIE, we have an additional element here whereby having an appropriate reviewer who was not involved in providing the service review, the audit work, or the service performer. But here we put here, if the case involved the firm to act as an advocate before a court or tribunal, so the firm shall not provide tax services that involve assisting in the resolution of tax dispute to an audit client, which involves the acting as an advocate for audit client before a tribunal or court. So there sometimes you'll be caught in a dilemma whereby there's an audit client and then this thing happened. So then how do we decide? So either you cannot, both cannot happen at the same time. So you cannot do the audit and you cannot do this. So then the client will have to decide whether which one to drop. Either you drop this one or you drop the audit. So maybe that's one of the ways how to handle this one. Okay. Okay, thank you very much.